Hello everyone! My oh my, it seems that every day there's some crazy news released about Icahn Enterprises. Trading under the ticker symbol IEP, we've been following this stock ever since the bombshell report by Hindenburg Research, which was published on May 2nd, 2023. The report, titled Icahn Enterprises, the corporate raider throwing stones from his own glass house, alleges that Chairman Carl Icahn was allegedly inflating the value of his company's assets, basically cooking the books. Most notable in the report, Hindenburg notes that as a result of the company's elevated unit price, its annual dividend rate equates to an absurd 50.5% of the last reported indicative net asset value. And, quote, the company's outlier dividend is made possible for now because Carl Icahn owns roughly 85% of IEP and has been largely taking dividends in cash, in units instead of cash, reducing the overall cash outlay required to meet the dividend payment for remaining unit holders. End quote. The big news right now, investors are digesting the news from the company's Form 10-Q that they filed yesterday that the company revealed in an SEC filing. It's under investigation from federal prosecutors. Super crazy. Yeah. The U.S. Attorney's Office for the Southern District of New York contacted Icahn the day after Hindenburg researched this short-selling report, of which accused Icahn Enterprises of a Ponzi scheme-like structure. And me, as a self-proclaimed freelance researcher on the internet, I have been following this stuff pretty closely to try and make some sweet, sweet tendies from day trading the stock, namely shorting the stock day in and day out. Sorry, it's not a stock. Technically, IEP is a publicly traded limited partnership, but we'll get to more of that at the end of the video if you're interested in learning more about how it differs from a stock. And I have to remind you to subscribe out there. Looking at my YouTube analytics, I can see that 85% of you out there are actually not subscribers. So come on, just click that button. Click it below. Okay, thank you. Though I'm thoroughly happy and surprised by the 281% increase in subscribers compared to last month. I mean, thanks. Thank you a lot. I'm really committed on this channel to bringing you quality financial content, and I'll be posting every day. I'm sort of like plain bagel, except that I didn't go to college for finance, and I love going on Wall Street bets. Anyway, this channel is devoted to increasing knowledge of investing, trading, and finance so that you can greatly increase your income. With all that said, let's get back to the video. Yes, last week I made $1,500 shorting the stock, and on Monday of this week, after a short recovery, I made another $800 shorting again. Here are screenshots for proof. As I'm a high-risk, high-reward individual, my short positions both times were around $12,000, so that marks around 10% and 6% trades, respectively. Yeah, I'm pretty proud of myself there, so I'm sorry, I had to brag a little bit on this show, and I'm actively short again on Icahn Enterprises. Not that I'm killing the game. I'm only trading with 20 small, so I am pretty proud of these gains. I made this 20 small through working Uber Eats and freelance video editing jobs for the first 6 months of my trading journey. I accumulated capital quick so I could start playing in the markets. Okay, so back to the show, I wanted to launch into the spot where Icahn Enterprises officially made mention of this investigation. So let's open the 10-Q and read from page 31 that they released yesterday after market close. Quote, the U.S. Attorney General's Office to the Southern District of New York contacted Icahn Enterprises LP on May 3rd, 2023, seeking production of information relating to it and certain of its affiliates, corporate governance, capitalization, securities, offering, dividends, valuation, marketing materials, due diligence, and other materials. We are cooperating with the request and are providing documents in response to the voluntary request for information. The U.S. Attorney's Office has not made any claims or allegations against us or Mr. Icahn with respect to the foregoing inquiry. We believe that we maintain a strong compliance program, and while no assurances can be made, we are still evaluating the matter. We do not currently believe that this inquiry will have a material impact on our business, financial condition, results of operation, or cash flows. Wow, you bet that that won't affect the financial condition of the company. The stock tanked 15% yesterday after this news broke. What with Carl Icahn and affiliated owning 84% of the units, shares, of IEP, and with him floating the dividend allegedly at a 50.5% premium of NAV, this seems pretty unsustainable to me. Just look up the stock on Google and you can find a quick read that the current dividend is 25%. Yikes. And folks, let me preface this. When it comes to dividend stocks, the first thing that many investors look at is a metric known as yield. This is the simple calculation that involves taking the annual dividends per share paid by a given stock and dividing that by the price per share to get a percentage. In this case, it's 25%, which is very unusual. So just remember here that a dividend is paid out in a dollar amount per share and not in a percentage. So IEP has declared that they'll be paying a $2 dividend per unit. And since their stock is tanked to $32 as of filming this video, that makes the percentage yield jump way up. So as the share price has been plummeting since the beginning of May, that yield keeps increasing and it keeps getting scarier and scarier. For comparison, you can look at a few different stocks that pay what are considered high dividends. Pioneer Natural Resources pays 11%. Devon Energy pays 9%. AT&T pays 6.5% and IBM pays 5%. You can quickly see that there is a sector differential in terms of dividend payout. Mature value companies tend to pay higher, and the highest come from energy-based companies, while tech generally pays the lowest, or even none at all. Seeing that IEP is a company that's comprised mostly of energy business, all right, then I guess a higher dividend than average may be warranted, but it still seems very fishy to me. Let's dive into some reporting here by a few different outlets. First, I want to bring up CNBC, and they reported, quote, a regulatory filing revealed the U.S. Attorney's Office contacted Icahn Enterprises last Wednesday seeking information about corporate governance, capitalization, blah, 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 blah. We already read that. We don't have to read all of those words again. So secondly, I thought this Bloomberg article was interesting. They report that, quote, the filing also disclosed that a default notice was delivered this quarter to a significant tenant in a commercial high-rise property that Icahn Enterprises owns through its real estate business. The lease was terminated after the tenant failed to make a payment, saying that it wasn't able to cure the default the filing shows. That is significantly worrisome to me. As a real estate agent, I have some insight on how the market operates, and I know that corporate real estate is just getting crushed. In this report, they reported this building was worth $218 million. Now, I've heard many stories out there of $200 million properties, corporate office buildings now being valued at maybe half the value because everyone's working from home in this new economy. So I'm sure that value of the building is just getting crushed there. And thirdly, Reuters reports Icahn has been seeking to reassure investors that IEP's dividend is safe after Hindenburg alleged that it's unsustainable because it relies on Icahn taking his own dividend in stock and IEP raising cash regularly by selling more stock. Again, they have 84% of all of the units, so they have a lot of pricing power to control essentially how the price looks and how everything feels out. While the company said that it would maintain its first quarter dividend, its first quarter loss and the prosecutor's queries raised new questions among some investors and legal experts about the company's ability to sell stock down the line. End quote. Well, this is definitely all very interesting. We'll continue the iconic reporting on the show here. That was a little joke. Iconic, Carl Icahn. Make sure to hit the subscribe button and follow us for more because I'm really interested in following this story. And just as a disclaimer, I do have an active short position on IEP. Now, I feel like every day that this story passes, it's kind of like a buy the rumor, sell the news. I'm shorting. I'm going to want to probably buy the news pretty soon. So I'm being very cautious with my short positions. Of course, make your own decisions in the investing market. I'm just doing my own independent research here and sharing that news with you. Now, at the beginning of the video, I promised talking about what IEP is versus a normal stock. What is a publicly traded limited partnership anyways? Friends, buckle up and let's take a ride through the wacky world of business structures. So you've got this thing called a publicly traded limited partnership, or PTLP, for those who love acronyms. It's like a love child between a limited partnership and those stocks that you see being bought and sold on Wall Street. Now, a limited partnership is like a party where you've got two types of guests. The cool ones with all the control called general partners, and the other ones who just sit there and smile, called limited partners. General partners are like the puppet masters. They call the shots, but if things go south, they're on the hook for all the partnership's debts. Limited partners, on the other hand, can't lose more money than they put in. they have limited liability. Now, you might be wondering how this PTLP thing is different from a stock. Well, buckle up because we're about to dive deeper into that rabbit hole right now. When you buy a stock, you're grabbing a piece of a corporation. In a PTLP, you're buying a slice of the partnership pie, as we call these units pieces, just to keep things interesting. With stocks, you get to vote on stuff like a contestant on a reality game show. But in a PTLP, limited partners just sit back and let the general partners run the show. It's like the difference between being a couch potato watching this show at home and being an active participant in the game show. Liability is a funny thing. In a corporation, you can't be held responsible for the company's debts. It's like having a get-out-of-jail-free card. Limited partners in a PTLP have the same card, but general partners are stuck playing Monopoly with no such luck. Now, let's talk taxes, everyone's favorite topic here on the show. Corporations get taxed twice, like a double whammy. PTLPs, though, work some tax magic. The partnership itself doesn't pay income tax, and all that financial mumbo-jumbo gets passed down to the partners. It's like a crazy game of financial hot potato. Cash flow and distributions are different too. Corporations throw you some cash now and then, like spare change from their pockets called dividends. PTLPs, on the other hand, have a schedule. They hand out cash to limited partners like clockwork, usually every few months. But don't get too excited about PTLPs. They've got their own bag of tricks, and sometimes the risks and complications can make you feel like you're stuck in a business-themed episode of The Twilight Zone. So if you're thinking about diving into the world of PTLPs, make sure that you know what you're getting into, or you might just find yourself up the financial creek without a paddle. And with that said, folks, thank you so much for watching this video. I'll continue to keep you updated with what's going on with Hindenburg and Icahn Enterprises. But for now, have a good one out there. Bye.